Hey, soldiers, where is a great place to put your money so that it doubles? Yes, doubles as quickly as possible. Warren Buffett might have some insight on that.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. So you know the investment universe is going to do very well. The Dow Jones Industrial Average went from 66 to 11,497 in 1 century. And then since that century has ended, it's more or less doubled again. American business is going to do well.
So how exactly do you go about investing in the S&P? Let's explore that. But first, go ahead and hit the thumbs up and hit subscribe if you're not already a soldier of finance. And if you are a soldier, you have hit that subscribe button, we thank you. Also, I want you to watch this until the end, because at the end or near the end, we're going to tell you how to actually supercharge the S&P so that it helps you build generational wealth and protects you from future taxation. Then I want you to leave a comment and let me know if you already invest in the S&P or are you planning on starting an S&P 500 related investment. So let's get into it. Why invest in the S&P 500? Well, one reason is because it offers diversification among the 500 biggest and some would say best run companies on earth. Another is because since 1926, the S&P 500 has averaged annual returns of 10.2%. Now, getting this diversification is important because, as we will hear from Warren Buffett again, picking stocks that are going to perform and are going to knock it out of the park, it's not easy. In fact, Buffett, he has a whole corporation built around trying to do that. Let's hear from him again.
The trick is not to pick the right company. It's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500 and to do it consistently.
Okay, so stock picking isn't the easiest thing to do, especially if you're not focused on that every day, right? And he is, and he, as you heard him say, he still doesn't have a 100% success rate. Okay, let's get a little bit deeper into exactly what the S&P 500 is. It's an index of 500 publicly traded large U.S. companies. Now that's important because, again, these countries are considered large cap, right? There is a such thing as mid cap and small cap companies. But what you're going to find in these large cap companies are, established names, companies that have been doing business for quite some time. And in many cases, you're also going to find that these companies pay a dividend. So you're going to actually be able to make a little income off of some of the stocks that are in the S&P 500. Now, the companies we're talking about, just to give you some example, Apple, okay, United Health Group, Berkshire Hathaway, which is Warren Buffett's company, Amazon, Meta / Facebook, Procter & Gamble, the list goes on and on. Okay, we got 500 companies in there. So that's basically what the S&P 500 is. Now, earlier I said that you're going to see annual average returns of 10.2%, and that is absolutely correct. But understand, that's not what happens each and every year, all right? This is an average we're talking about. But with regard to the S&P, a lot of people say that it is the best gauge of U.S. stock market performance. And some might say, well, what about the Dow 30? Well, that's only 30 companies. The S&P is 500 companies, so it's broad. And as of year-end 2022, the total market value for the S&P 500, all of the companies combined, was $33.8 trillion. Let's go ahead and call it $34 trillion. That's the equivalent of the economic output of the United States, Japan, and Germany. All right. So these are heavyweights we're dealing with. Now, in order to get added to that index, let's say you got a company and you want to, entertain getting added to the S&P 500, the shares must have a minimum market value of $12.7 billion, half of which must be publicly traded. So roughly just over $6 billion in shares have to be available to the public. The company must also have positive earnings over the past 4 quarters, and its stock has to have traded for at least 1 year. Companies with larger market caps have a bigger share of the index. So take Apple, for example. Their share of the index is roughly 27% because Apple is a company with in excess of a $1 trillion market cap. All right, let's get into more of the historical performance of the S&P 500. But before we do that, I want to give you a method to test how hard your money is working for you. It's very simple. It's called the rule of 72. And basically what you do is you take 72 and you divide it by whatever your rate of return is. So let's say 10%. Okay, so 72 divided by 10 is 7.2. That 7.2 is a figure that will give us the amount of years it will take for the money to double. So let's say you put $10,000 into an S&P 500 related fund, ETF, or insurance policy. Okay, if the S&P 500 is returning on average 10%, and if you can average that over the course of a few years, your money's going to double in 7.2 years. 72 divided by 10, that is the rate of return on average, 7.2 years. Now, let me pause right here and say, stocks aren't for everybody. You need to do your due diligence, and you need to figure out if you're at a point in your life where investing in something like the S&P 500 makes sense. Now, if you're younger, it tends to make sense because you got a big time horizon. And if your money is doubling roughly on average every 7.2 years, you got a lot of 7.2 year periods. And remember, if your money doubles, let's say you put in 10,000 in 7.2 years, it doubles. Okay, so now you got 20,000. You leave it alone. You don't put any more in there than 10,000 for our example's sake. Okay, so in 14 years, what have you got? Okay, you've got 40,000, and on and on and on. You can see how that compounding takes effect. Now, the S&P 500 can be volatile. We're talking 10.2% annually on average since 1926. That's roughly a century of pretty decent performance, right? 1926 is when the S&P, or Standard & Poor's, their predecessor, began tracking an index of stocks on a daily basis. But just like the broader stock market, we're going to find some volatility. And for example, just here recently in 2022, the index dropped by 19.4%. But remember what Warren Buffett said. He said invest in thick and thin. And if it's on a 20% discount, basically, why would you shy away from that? Also, at the end, when we talk about how to supercharge this thing, we're going to show you how you can actually install a floor so you don't take that ride all the way down to the basement and lose 19.4% as the S&P dropped in 2022. Now, of course, 2022 was a poor performing year, but guess what? 1931 was the worst performing year. It was the start of the Great Depression, of course. At that time, the index had 90 stocks in it, not 500, but it lost 47% of its value. Okay, the absolute best year was a few years later, 1933, when the index surged by 46%. Okay, because we saw the economy start to kind of recover. Here recently, we had the Great Recession in 2008. It dropped 38.5% and didn't come back until really 2013. So I just want to put that out there because volatility can be your friend, especially if you have a time horizon to make these recoveries. And again, I can't stress enough, watch to the end, because when we supercharge this thing, we're going to show you how it actually is able to, get that floor in there. Now, the fastest decline that the S&P has had was in the 5 weeks after the whole 2020, thing got going. The S&P 500 lost 33.9% in 5 weeks. That was the fastest decline ever. But it did better than, some broader indexes at the time. And, it, after all that turmoil was over, it started to recover that. Now, investing in the S&P 500 is not difficult at all. You do need to do your due diligence, okay, to find out if this is right for you. You can't just take my word for it because we don't know each other, right? I don't know your situation. But most people who do invest in the S&P 500, they get in through an index fund, exchange traded fund, or mutual fund. And those vehicles are going to basically replicate the performance. Now, you find these avenues like the mutual funds typically in 401ks or 403bs. They offer at least one, most offer at least one S&P 500 related index fund. And you can purchase an S&P index fund through a plain Jane vanilla brokerage account. And you can hold it as an individual, just I've got it and it's not in a qualified account. Or of course you can hold it in a qualified account like an IRA or, as I said, a 401k. These S&P index funds, ETFs, and mutual funds, they are offered by some of the biggest names in finance: Vanguard, Fidelity, T. Rowe Price, JP Morgan, on and on and on. So you might ask, well, what differentiates them? Well, fees. The average asset-weighted fee for S&P 500 index funds is 0.05%. You also want to think about whether or not you're going to go for, at least initially, whether or not you're going to go for an exchange-traded fund or a mutual fund. Now, they're similar, but there are some differences that investors need to know about. For instance, mutual funds share prices calculate at the end of the trading day, while an exchange-traded fund or an ETF is calculated throughout the day, kind of like a stock. Now, these things are not meant to be traded back and forth like some Wall Street trader, okay? It's not meant for that, especially for us, the retail investor. But it is true that ETFs, their prices fluctuate throughout the day. ETFs are also going to be more tax efficient. And that's because of the difference in the way shares are added and retired. We're not going to get into that because that's kind of complex. Mutual funds, they have to pay out any realized gains to shareholders on a pro rata basis at least one time a year. Now, it's for that reason investors may want to avoid S&P 500 mutual funds in their taxable accounts and choose a comparable ETF instead. And that's just, you're going to get hit if you have it outside of that qualified account. You're going to get hit with capital gains tax if there is a gain, okay? But the tax efficiency of ETFs or exchange traded funds, again, it's not necessary if you own that S&P 500 index fund inside a tax deferred qualified account, such as a 401k. All right, I promised you we talk about how to supercharge the S&P 500. We've talked about why you might want to get involved in this after doing your due diligence, because you are looking for returns that are going to double your money in the quickest time possible, right? The younger you are, the broader time horizon you have to make that happen. So time is on your side. And look, even if you are, not 20, okay, you still need to examine this because 7.2 years is not a long time, all right? If you are 30, 40, even 50, right? So examine it based on your due diligence and your needs, your horizons, and your goals. Now, in terms of supercharging this, we've got 3 ways to do that. Let's talk about the floor first. Believe it or not, certain types of insurance policies allow you to index and link that to an S&P related tract, okay? In many of these policies, there is a floor. So we talked about the fact that the S&P 500 lost just over 19% in 2022. Well, with certain insurance products, the floor is 0%. So imagine that elevator stopping at the first floor while everybody else who doesn't have that insurance product, but they're in the S&P also, they take the ride down to the sub-basement. Now, the thing about that is getting out of the sub-basement is going to take time. Coming back from the first floor, of course, is going to take less time. What do I mean by that? Well, think about it. If you have $100 and you lose $50, what is the percentage you will need to realize on the remaining 50 in order to get back to 100? Many people will say 50%, but no. Of course, if you make 50% on a $50 principal, you're only going to get back to 75. You need 100%, okay? So if you look at the math and you're on the first floor, you didn't go all the way down to 19.22%, you stopped at 0, it's going to take you less time to start realizing those gains and get back into the black, much, much sooner than the lady who took the ride down to the basement. Now, the other piece of this is the generational wealth aspect. If you use one of these indexing strategies inside of an insurance policy, then it gives you the ability to pass on wealth totally, in most cases, tax-free. Okay, and we're talking in some cases, hundreds of thousands or even millions of dollars. It depends on how you structure it. All right, and finally, let's throw this up. Here it is. This is the running tally of the national debt. We did the report on how the national debt is projected to balloon to $50 trillion by 2032. That's 10 short years away. Who's going to pay for that? You. So you need a bucket of money, okay? I'm not suggesting you put all of your money in any one basket, but you do need a bucket of money that is shielded from future taxation, because as we see these numbers rise in real time, we can surmise that, of course, taxes are going to be higher in the future than they are now. So why not, for some of your money at least, consider paying taxes now while they are lower, and then on the back end, enjoying a tax-free bucket of money that's not exposed to this over almost $250,000 per taxpayer. Now that's at $31 trillion. Wait until it gets to 50. How much will you be responsible for as a taxpayer? So wouldn't it be nice to shield some of your money from that? And those insurance policies help you do that. If you want more information about that, contact us through mcenow.com. We'd be happy to talk to you about it. There's no obligation or anything like that. And watch the report we did about that $50 trillion. This point needs to be driven home. Watch the report we did about the $50 trillion that we're going to run into as national debt by 2032. And then rewatch this video. Share this with someone you love in order to really inform them about how to double your money using the S&P 500. Okay, now, again, I just want to stress short term. This is not what we do here. We're long-term investors. So we're looking at that average over time to average that 10%, annually over time. Okay, guys, I'll talk to you soon.